This is Mike Adalizzi, Executive Vice President with the American Supply Association. You're logged on for the ASA Industry Forecast webinar with Alan Bolio. I'd like to give a couple of quick housekeeping announcements. Alan, if you can click to slide number 2 with our supplier partners on your screen. ASA wishes to acknowledge and thank those ASA manufacturer members that have become supplier partners. It's through financial contributions from our suppliers that have allowed ASA to develop programs such as this forecasting program that we've launched last year in Network 2012 in Orlando. Currently, you're all muted. You're going to be able to hear Alan give his presentation. The session is going to last about an hour. We'll allow, I think, 15-20 minutes, Alan. It seems good enough for questions and answers at the end of his session. If you do have questions, we like to direct you to the dashboard on the right-hand side of your screen. Just click on the questions window and type in your questions whenever you have a question. We'll be able to see those questions and then read them to Alan towards the end of the session during the question and answer period. And of course, you can always log them in at the end when Alan's answering questions as well. Hopefully, we'll have enough time to answer all of your questions. This session is being recorded and will be available for replay on ASA's members-only site. It'll take about 48 hours to make it available. You will receive an email from us letting you know that the webinar is available for viewing should any of your other employees like to view the session. Network ASA 2013 in Washington, D.C. Alan will be there presenting the 2014 forecast. So if you're not yet registered for Network 2013, there's still plenty of time to go ahead and do that, but I'd urge you to register prior to September 1st, and fees are going to go up $100 at that time. So I'd like to get you to go ahead and get those registrations in. As I said, this is part of ASA's industry business intelligence program. We've got a lot of great programs available. Currently, the OPR report is complete and now available. ASA will be conducting a compensation study later at the end of this year, beginning of next year. So that's a new study that I think a lot of you will have interest in. So that'll be ready by spring. And as part of this webinar is part of the overall forecasting. Alan gives the year ahead forecast at convention. Then we do 2 webinars that Alan has an opportunity to kind of give you an update as to what's going on and how it changed from his forecast the previous year. In addition, you all should be receiving the monthly ASA Advisor, which is authored every month by Alan, kind of giving you an up-to-date, month-to-month up-to-date as to what's happening. So hopefully you're all receiving that. Our presenter today, again, is Alan Bolio. He's president of Institute for Trends Research. ITR has boasted a 94.7% accuracy rate since 1948, and it has had 60 years of correct calls. It is the oldest privately held economic research and consulting firm in the U.S. Alan is one of the country's most informed and correct economists. He has been consulting since 1990 with companies that have both a domestic and global perspective on how to forecast, plan, and increase profit based on business cycle trend analysis. Pronouncements from Alan have appeared in publications such as Wall Street Journal, New York Times, USA Today, Knight Ridder News Service, Business Week, AP, and numerous other outlets. ASA has retained Alan and the professionals at ITR to provide ASA member firms with their insight about the trends you need to be aware of to stay relevant and successful in the future. By the way, when you hear Alan, you'll notice he's quasi losing his voice, so hopefully he'll hold out for the next hour. So Alan, I'll turn it over to you. Thank you for joining us.
Thank you, Mike. I really appreciate it. Thank you to our sponsors and to everyone for joining us today. I apologize for my voice. Obviously there's nothing I can do about it. We'll just do the best we can, but I do apologize because I know it can be irritating. Let's get to work then and talk about what's going on in the economy and what we can expect as we go forward in life, as it were. And all of a sudden I've lost my capability for advancing the slide. So there we go. Okay, we're back. I want you to just know that results are tracking through the end of 12 as we had anticipated. We update this information every 6 months, and through June 2013, we are holding with the same accuracy rate. 12 months into the future, the over 600 series that we forecast, we still have that 94.7% accuracy rating. Despite all the uncertainties in quantitative easing and stresses that people feel around the world, we can still get a handle on the forecast, which means you can get a handle on the forecast and know what's going on in the world around you and be ready for everything going on in the world around you. It is possible to know what's going on. As a quick reminder, we take monthly data, raw data, we convert it into a 3-month moving total, and then a 3/12 rate of change. We also take the annual data, a 12-month moving total. It's computed every month. It's not done annually, but it is a 12-month figure, thus making it annual. We do that math that's shown on the screen in front of you, and we get a 12/12 rate of change. A lot of our work is based around logic. The tool that we use is rate of change. So we can see what's happening in terms of internal pressures. We look for leading indicators, extant measures of activity, do our comparisons and analysis, and come up with those forecasts. Hopefully you're doing the same thing for your businesses. This is a great internal tool. It's not just meant for the external environment. As you use 3/12s and 12/12s in your businesses, you inherently have a mathematical leading indicator of the business cycle pressures confronting your business. All right, let's go on from there. You can see how it works. This is a real company in green. This is a leading indicator in blue. This company obviously lags the indicator, which is natural since it is a leading indicator. Your company will too. This industry will find that there are good leading indicators. You can see that it forewarns the company leadership about what to expect. Currently, what it's signaling is that the decline in the rate of growth that the company is experiencing, the green line, is temporary. And it's going to turn the corner and experience a mild improvement here in the second half of 13. Let me adjust the timeline, and you can see that. Because of the historical relationship, that company can impute that blue line as its own and say, you know what, things are going to get a little better as we finish the second half of 13. Not a lot, but I don't have to worry about going into recession for the next several quarters. That's how you use rate of change. That's how we do it, and that's how you can do it too. We also see in front of us that rates of change can be used to see a large environment like the U.S. economy. The industrial production trend is in blue. The economy is slowing on the industrial production side. All of GDP, though, is leveling off. We're going to find, my friends, that the economy is basically stable, moving horizontally through the second half of 2013. Very consistent with the forecast we've had in place for the last 6 months. Back in February 2013, we adjusted the forecast. Some of you may remember that. A year ago at conference, we talked about a mild decline in 2014. We still have that mild decline. That green line in front of you is a forecast. Stability through the near term, then mild decline. The only thing that's changed is that we've raised the trough some. Now, we haven't raised it a lot, but you should know that we have raised the trough if you haven't read anything from us in the near term. 6 months ago, that trough came up, and the timing got pushed out a quarter as to when that inflection point is. That inflection point that you see in front of you is about March 2014. We used to have it as December 2013. The reason for the change is straightforward. It's not a mystery. It's China. China has opted away from a massive stimulus project, which was four-pronged for 2013. They were going to invest heavily into housing, into high-speed rail, into infrastructure, and into cleaning up the environment. They decided not to do that. When we laid down our forecast, it was under the assumption that China would have that spending going on. It would demand world's goods. It would bid up some commodities, causing some mild inflation, including in the United States. That mild inflation would have a negative impact on consumers for 2014. It's just a matter of connecting the dots. When China opted for structural reform instead of stimulus spending, they chose wisely, but they took away that inflationary pressure from this year. Good choice on their part, and it also makes things easier for the American consumer in 2014. And so we have this very mild downturn, flat year as much as anything. and then we're going to find that the economy picks up speed post-2014. So in summary, you're going to like the rest of 2013. It'll be good for you. Not great, but good. 2014, expect some softness. In 2015, expect things to get better. When we look at the industrial production trend and that forecast out we just had on the screen in front of us, we can compare the trend to wholesale trade of hardware and HVAC equipment and supplies. The economy obviously matters. So that horizontal move that we're anticipating, the blue line, is good news for the wholesale industry. The softness in 2014 speaks to some downside pressure in the wholesale industry for 2014. Thus, as you're listening today, should expect some of that same pressure on your business. Again, nothing like 2009. Please do not infer that there's anything really bad coming. It's just I don't want you to say that you experienced, let's pick a number, 12% growth for 2013. And assume that you're going to have 12% growth in 2014. You may, but it will not be the economy giving it to you unless you are focused on the commercial construction side of the economy. If you are focused on industrial or residential, you're going to find that your opportunities are more limited, and you're only going to get that 12% rate of growth because you're aggressive with your marketing and your sales and positioning, not because the economy has gifted it to you. It can be done, but it certainly won't be easy. The non-res side will fare better in 2014. So we look at the wholesale trade of hardware, plumbing, HVAC equipment, and supplies. Notice that the rates of change are on top. Please note that the orange line, the 312 rate of change, is a little below the 1212, just a whisker, but for the last several months it's spent more time below than above. That means that there's still that period of sluggishness, a slower rate of rise. I have annotated there for you on the screen DT, rising through 2014. That stands for data trend. The data trend I'm talking about is the bottom blue line. That's the amount of money being spent. There's $111.5 billion being spent in this segment of the economy. The growth rate is going to slow in 2013. To the end of the year, it's going to slow from 5% today to 3.9% by the end of the year. And we're going to see it slow in 2014, but the dollars will continue to grow. So you may not get that fictitious 12% rate of growth, but neither are you likely to see a negative number develop unless you're in a region of the country that happens to be particularly hard hit by the housing downturn, or softness would be a better phrase. My reasons for optimism are straightforward. We've shared these before. There's nothing that has changed here. The Fed is still providing stimulative monetary policy, and they are likely to do so in some amount through the end of the year. There seems to be a growing feeling that they will begin to back off on QE spending as we enter into 2014. I certainly hope so. As they do so, we think it will slow the rate of growth in the stock market and provide for some downside pressure, as we believe QE is providing some air into the stock market optimism, if you will, that doesn't really belong there. Stock market length of rise is longer than normal. Corporate profits are beginning to slow in their rate of rise, and slow very noticeably. And therefore, you would expect that there would be some downside pressure in the stock market. Combine that with lack of stimulative spending by the Federal Reserve, and we're likely to find the stock market moving down, which is consistent in what you would expect for a 2014. And if that actually happens, that feeds into our scenario that the economy in general is going to slow down in 2014. It's consistent with businesses wondering whether they should continue to spend, consumers cutting back on their spending, less hiring going on. Less hiring means less spending going on. All of that kind of feeds together. There's no separate piece. They're all interwoven, and they seem to be pointing towards slower growth, very noticeable slower growth in 2014. And if you're looking for a prick that will burst the balloon, we could tag it on QE if you want to. I happen to think it's more taxes, and the fact that disposable personal income in America is growing at a very mild 0.7% year-over-year increase. Inflation's also mild at 1.8%. That's a nice, comfortable rate of inflation. But it still means that prices, the consumer price index, is moving up faster than our after-tax income. And that's a subtle pressure on consumers. That's a very subtle pressure that will just continue to build. And we think it'll manifest itself in 2014 in less consumer spending. through the rest of this year. And these are all good things in front of us, positive things going on. Just trying to lay some of the groundwork for some of the problems that we are anticipating for 2014. Right now, there is absolutely no threat of a spike in material and component pricing for construction industry. The rates of change are negative. The pressures are mild. 2.2% year-over-year growth, nice and comfortable, especially compared to where we have been in the building boom. And you should easily be able to deal with the material pricing pressures over the next year. One place that we are going to see some pricing pressure will be in oil. I have the oil outlook there for you on the screen. It may not literally be 106 today because this was not prepared today, but the outlook calls for above 100 on oil prices through the rest of this year. Increased demand, uncertainties in Egypt, Syria, Middle East make it very easy to expect over $100 a barrel through the rest of this year, and then you can see that it quickly pulls back at 2014 as we see the economy beginning to slow. Demand will fall off. Energy prices will not be an issue. In the meantime, it's just something you may want to plan on. Buy for the first half of the winter if you can, or at least plan on higher delivery and energy costs. It'll show up at the pump through the rest of the calendar year. Interest rates have begun to move up. That's the blue line. That's great news for us in that we have forecasted it. We had talked about it. We encouraged you to go out there and get a low-price loan while you could. Interest rates are still historically very low. Go out there and grab some of this cheap money and invest in your business, invest in your growth potential. And we're not expecting this to just spike right up and do the classic hockey stick kind of move. It's not going to do anything of the kind. It will pull back next year, 2014. Not down to the trough, but it will pull back. And then it'll wind up and down. And you see how it's been an uneven decline? Well, we're just at the beginning of an uneven rising trend. Just plan on that as we go forward. The near-term impact is not terribly significant. The rise in 30-year mortgages to roughly 4.5 is not going to cause the market in and of itself to come to a halt in terms of recovery or to crash. It may even spur some near-term buying as people begin to wonder what's happening in rates. They may move into the marketplace. The near-term impact is just one of a warning shot. Understand that we will see higher interest rates in the future, and just make that into your business plans as you go forward. For 2014, it's not going to continue to move up, so there is no near-term deleterious impact. When we look at problems in the world, I'm going to talk quickly about Europe, China, etc. The big one on the agenda for today is under the heading of massive legislative changes and the Health Care Reform Act, AKA Obamacare, which is okay. That's an okay phrase to use now, politically accepted. The president's health care plan is going to have an impact on the economy, we feel. It's going to have an impact on rates. It's going to have an impact on what businesses pay for insurance, and it's going to have an impact on what employees pay for insurance as they contribute towards those increases. As the increase occurs off of a baseline, more and more employers are asking employees to contribute. As those employees contribute, they have less money to spend on other areas. Cumulatively, that has an impact in the economy. In addition, there's a growing belief, may be the wrong word, but the growing suspicion that more and more healthy young Americans are simply going to pay the fine rather than buy expensive insurance through an exchange or from their employer. The fine is relatively minor compared to the cost of a policy. So as they pay their fine and go their way, they're not coming into the system. As they're not coming into the system, that throws the mathematics of the whole Health Care Reform Act out of whack. It no longer works. We need the healthy 25 to 30-year-olds to come in and buy fairly expensive insurance to subsidize the older population and thus keep the insurance rates and costs down, contained. If they do not come in, the containment does not happen to the same extent. There are studies that are talking about significant price increases for insurance in some parts of the country. For instance, a healthy 25-year-old male in California, the study says, could be paying 50% more for insurance in 2014. That's a significant impact. Obviously, it's isolated and maybe not that extreme, but the thought is consistent with our projection of a slower rate of rise. in 2014. And we still have Dodd-Frank legislation coming in. It will be having a restrictive impact in the credit markets. Restricting the credit markets does slow down economic growth, at least until we adjust, figure it out, or otherwise see it repealed. The bottom line is that we are going to have some headwinds from legislative changes. We are going to see, the impact of sequestration, increasing the deficit through raising the debt ceiling, threats of federal government shutdowns, all sorts of fun things will be happening as we go forward. Just keep in mind that all that does is create lots of uncertainty out there, and uncertainty is bad for business. Government will be making noise. Both parties will be sounding off. It'll be a fairly confusing time for most people, and that confusion will mean less jobs to be created. So healthcare is likely to cause job growth to slow down, and we believe that the Washington antics will cause a slowdown in job growth. There is really no fiscal cliff, but sequestration is real. The other aspect of sequestration to remember is that the amount of money doubles for 2014 from 2013. Now, it won't be a doubling of the impact because we'll go through the shock, but the amount of money that Congress could not wrestle with in 2013 will double that they will have to wrestle with, in theory, for 2014. And that was likely, that is expected to have a psychological impact as we go forward. The return of the FICA tax, the increase of 2 percentage points is part of the reduction in disposable personal income and part of what we expect to see as a slower consumer environment in 2014. I did want to show you that Europe is looking better. As we had talked about over a year ago, forecast is coming around results are coming around just fine relative to forecast. That green line moving up, man, that's exciting. And the fact that that leading indicator, the orange line, is moving up tells us that it's going to continue. It will not be impressive, but it will be heading in the right direction, and there will be good news coming out of Europe. There is a cloud to all of that, in that if the U.S. dollar weakens against the euro, it doesn't have to weaken a lot, but if it does weaken noticeably against the euro, European banks, which are subject to mark-to-market, will be having to increase their reserves because their capital base will erode proportionately. It's estimated there could be up to a 20% reduction in the capital base of European banks. If that happens, lending obviously slows down dramatically, credit tightens up, interest rates move up, and that hurts the European environment. Hurting the European environment does have a national impact, because they are a large economy. The EU 28 is slightly larger than the U.S. So this is important stuff, my friends. I don't think that's going to happen. I don't think we're going to see a collapsing dollar causing a collapsing European banking system. But just keep your eyes open as you're scanning the news, and keep your ears open, and we'll certainly do our best to let you know if that develops so that you can see it happening and tell your kids about it, or at least prepare for it. When we look at other leading indicators relative to the world and Europe, they're positive. That's all that this graph is for, is to show you that things are getting better, different sources, different methodologies. Life is good. There are growing investments in the FTSE and the DAX. Good news is just breaking out all over the place. Manufacturing is increasing in Germany and Italy and Spain, and we're finding that business confidence is up in the Netherlands and Belgium and Germany. Consumer confidence is up in Italy. There's even some good news coming out of Spain. Things are beginning to just look better as we look at Europe. This does not have a near-term projection. I just want to comment on it because it's happening now. What's happening now is that you're hearing about a narrowing of the budget deficit, and there's a thought process among people to straight line forecast that which we hear. And it may last a little while longer. The Congressional Budget Office, the source for the information on this chart, actually for the chart itself, which we got from the Wall Street Journal, they got from the Congressional Budget Office, called for that narrowing to occur. A lot of that is statistical, but you can see that the Congressional Budget Office, has no concept of a surplus. They have no concept of a balanced budget for the next 10 years, which means the deficit only widens out into the future. The national debt continues to increase. The amount of interest that we must pay continues to increase. So through the near term, you're going to get to feeling things are better. My job is to make sure that we deal with reality, and reality is there's no substantive long-term improvement occurring in Washington. We are not going to find any rescue from the long-term pain associated there. The world is fundamentally a good place. As we look at that good news, we can see there's green all over the place. In Brazil, which is at minus 0.5%, since this chart was created, has actually moved to the positive. It should also be in a very light green. That means that there are opportunities, positive numbers, and that means that economic growth can occur. The world is depending upon the United States and China right now. Both nations are providing that strength that is necessary for economic growth around the world and recovery in many nations. When we look at the future, we always look at the train that is the economy. Think of these arrows and these words as different cars on a long train. What's going on now is that the engines, financial, housing, and retail, are leading the way. That means that new orders, wholesale trade, prices, production are all going to follow along. They're going to climb that hill in the second half of 2013. They're going to be in that horizontal to mildly positive mode that we talked about. But we already see there are signs for that slowdown in 2014. It's happening in the financial sector, and it's happening in housing, and it's beginning to develop in retail. That will begin to manifest itself in B2B activity, but not right away. Right now, B2B is doing very well. The rates of change are positive. The blue line on top, it's moving up. The dollar amounts at the bottom, record high level on the orange line, the 3-month moving total. The 12-month moving total, it's moving up. Good news, businesses are spending. CFOs are letting the money go. It's not going to last more than a couple more quarters, and then we're going to find the uncertainties and the difficulties that we've already discussed will be causing B2B spending to slow. It'll show up first in the rates of change. We'll make sure that we bring it to your attention when that does occur. The ITR leading indicator is saying that we should be bullish on the second half of 13 and providing a hint of some problems for 2013 as you look at the extreme right-hand side of that orange line. As it moved up, that's 13. Timing-wise, as it moves down, that's actually 2014. It's not saying any cascading problem like 2009, but it's saying there's something out there and we should keep looking for it. Pretty much the same input from consumer expectations from the University of Michigan. We convert their, monthly numbers into a rate of change. The rates of change are on the back side. They're negative. They're not crashing. We're not saying anything that would lead us to expect a dramatic pullback in the economy, but some softening in consumer spending, and some softening in consumer spending means a slow rate of rise, and you will have a harder time maintaining a rate of growth. The Chicago Fed National Activity Index is at minus 0.2. Anything below 1 means we're growing at less than typical rates of growth. The fact that it's trending lower means that we should expect more of the same as we go forward. It has to go below that black line, that minus 0.7, to signal recession. All we're seeing right now, slower growth and sluggishness being signaled by the Federal Reserve Board. Purchasing Managers Index is bullish. It says that life is good for the next 6 to 9 months. The U.S. Composite Leading Indicator up until the most recent month was saying that things are good. That means into early 2014, life will be good in the United States. You're going to enjoy the second half of this year, the rest of this year. Stock markets moving up, and that means that we'll see some upside pressure. That means that we will see, on average, the economy continue to expand. Let me just comment quickly. This is only an average leading indicator. It's not a good one. It's an average one. And it tends to lead by 6 months. So the takeaway from this is that if it's working as a leading indicator, we're good into early 2014. My take is that that is exactly the correct analysis, and that this is telling us that we are good till at least early 2014. When we look at corporate bond prices, you can't get a much more negative view. The corporate bond prices, rates of change that you see in front of you are telling us that there's definitely something bad forming for 2014. It may be just a mild downturn, but we can put that under the heading of unwelcomed and something we don't want to see. Nevertheless, we should plan on it. The movement in corporate bond prices is also a precursor to changes in the stock market. It's not infallible, or else everybody and their brother would be using it, but as an indicator of stock market and what we should expect, it's saying that the current bull market is getting long in the tooth, and the fact of 3-month moving average decline in corporate bond prices tells us that we should expect to see the stock market move into a correction for 2014. That correction could easily begin in the last quarter of this year. Retail sales looking good, but we've talked about the problems there. It has to do with disposable personal income. That's interesting. One of the things that I want to bring your attention to is the fact that this chart in front of you is also, because of scale and perspective, not highlighting as much as it should the rate of change decline going on in housing starts. That orange line is actually dropping below the 1212. The 1212 is more negative than what you can see on the screen. And that's showing us that there is a turn in the economy coming too. Expect housing starts to flatten out in the last quarter of this year, to plateau. Expect there to be a mild decline in housing in 2014. We have not changed our forecast in terms of its shape. We've changed the number of units, if you read the ITR Trends Report, by 38,000 units, a very minor change to the outlook. We're still expecting backside of the business cycle activity for 2014. The rates of change are signaling it, and everything we've talked about with consumers would also argue that that will be the trend. We see that phase C is in the west, northeast, south, midwest, multifamily. The data is still rising. We still have recovery going on. New homes sold are still in B. Existing homes sold are still in B. That means it's growing. But the new construction is slowing down, multifamily, and we're going to see new homes sold also shift to phase C before the end of the year. Existing homes sold are also going to shift to phase C. That's a much slower rate of rise. Again, that's consistent with my forecast that your rate of growth in 14 is not going to be the same as it was in 13. When we look at what consumers are willing to spend on improving their home, the rate of change, the orange line, the 312, is below the green line. That means there's a pending shift to the backside of the business cycle. I think you should plan on that for 2014. It'll be harder to get consumers to fix up their home. They'll decide there are lots of things that can just wait. Multi-unit housing starts are already slowing down. The rates of change are clearly on the descent, with more descent to come. And we're going to see that growth rate slow to 18.5% by the end of 2013 and a 3.7% growth rate in 2014. Now, I did use the phrase growth rate. That means that the dollar amount, well, it is the dollar amount too, but the number of units will continue to rise, which means the dollars spent will continue to rise. You will be selling product here. You just will not be selling it at the same pace that you enjoyed in 2012 and in 2013. Non-residential construction, the dollar amount's going to go up through 2014, but the rate of rise is going to be cooler than what you enjoyed in 2012. We're going to find that the rate of rise is not bad. It's just if you're building your model around the peak, which was close to 12.5%, you're going to be disappointed. Currently 3.3% growth rate. That 3.3% growth rate is going to improve to 4.4% because of a mild increase in activity in 2014. That mild increase in activity is because of the normal lag that non-res has to the economy. The prosperity that has been in the economy, that will be in the economy, will cause projects to be started. Those projects will last through 2014. The number of projects started means that there'll be good opportunities in the commercial side of the economy. The number of office buildings is slowing its rate of rise. That's the bottom blue line. You can visually see that it's slowing. And it's going to continue to slow, but that doesn't mean an end of construction. It just means less opportunities as you go forward. Hospital construction, flat, going to be flat to mildly negative till we figure out what all this healthcare information means. As we look at the overall construction segments graph, I'm pointing out the things that are not doing well with all the declining going on. Public construction, federal government construction, private healthcare, private education, manufacturing buildings. There's a lot of decline going on. Some of that's going to reverse direction in 2014 later in the year, but not a lot. It's going to be a mixed bag. Stay tuned to the webinars. We'll be talking more about this when we meet in Washington, but for right now, there's a lot of phase C, slower rate of rise, that's leading to more downside pressure, data trend decline. There's a couple phase Ds, overtly negative, continuing to fall away. As that occurs, it's going to be harder, through the near term at least, to sell into this segment, but overall the non-res segment will still outperform the residential segment in terms of opportunities in 2014. And with that in place, I am more than happy to answer questions in the 15-20 minutes that we've allocated for Mike. If you want to lead the discussion. In the meantime, I think what I will do, my friend, is just bring us back up to the sponsors because we are so grateful to them for bringing this webinar to all of us, for all of us to be able to share this time together.
All right. Thank you, Alan, very much. We have an initial question. Ben, would you like to read it?
Sure. Alan, do you still predict that residential construction in the second half of 2013 will offset the weakness in the commercial market?
Yes, I think you're still going to find good opportunities in residential in the second half of 2013.
Alan, we did have a question about the slides that you've shown being available. Ben?
Yeah, there was a couple of questions actually on whether the slides will be made available, and they will be. We're going to post them on our website at www.asa.net. We'll also send an email to all participants with the slides in it. So that we'll have that out in the next day or two.
Another question, Alan. How would the change in the Fed share impact your predictions?
That's a really good question, by the way. I was wondering if that was going to get asked. The answer is it won't change the projections, but it'll be very interesting to see. President Obama's comment that they're basically the same in your views is not correct. They're not basically the same. Ms. Yellen is very much more of an inflation dove and actually believes in stimulus spending and quantitative easing. Larry Summers, while we would disagree in several areas, does not see a lot of benefit to quantitative easing. And while he has softened his tone, for political reasons I suspect, and says it does no real harm, he will also add it does no real good. And therefore he would be the one who would more quickly end quantitative easing. A quicker end to quantitative easing would be good for us in the long term. It speaks to less inflationary pressure, and it's consistent with our outlook of a nice, strong, vibrant economy beginning in 15 and going through the middle of 18. If we find a Ms. Yellen who lets in a lot of inflationary pressures, that could bring in the problems of 19 into an earlier year because the Fed will have to act much more quickly and aggressively in the face of mounting inflationary pressures. It'll be interesting to see.
Okay, next question, Alan. How much of a contribution to growth will the 2016 election have in, I'm sorry, hold on. 2016 election have in the years 2015 to 2016?
Well, the answer is if you're in the advertising business, it makes your day and you're as happy as a duck in water. If you're in the hotel business in key states, it has a lot to do with your ability to sell product, and it'll be good for you. For the macro forecast that I have laid out here today, it's inconsequential, and it does not change anything. You do not see a bump in the national economy every presidential election year. Statistically, by the way, we are in recession a third of the time. We're in growth two-thirds of the time then, and you do not find that the presidential election cycle alters that relationship or that presidential election years are better or worse on average.
Okay, another question, Alan. Do you have for us any phase management objectives for second half of 2013 and first half of 2014?
Yes, I do. They're pretty straightforward too. I think the future is bright. I think once we get past the softness of 2014, you're all going to be much busier than you are now. So my phase management objective is to look for the bottlenecks in your company. It will vary from company to company. You may need to hire a CFO. You may need to hire a new senior sales manager. You may need to hire more route sales. Whatever it is that you need to have, a hunter-gatherer instead of a farmer. Go out there and get that person. You may need an ERP Put in the ERP. You have a year to get it done and get it right before you start getting so busy you don't have time for it. Your costs for doing it will be less now. Your time to do it is good now. If you're thinking of expanding your operation to another city, now's the time to do it. If you're thinking of doing anything in the way of a BHAG, now's the time to do it. Whatever it is for your organization, and it will be as varied as the number of people listening to this webinar, make sure that you get it done in the next year. Drive efficiencies ruthlessly in your organization while you can. Before inflation, before you get busy, make yourself as efficient as you can. That will involve spending money on capital equipment in a lot of cases, and in all cases it should involve spending money on employee training, knowledge, techniques, methodologies, lean. Spend the money and get it done.
Thank you, Alan. Next question is, do you still predict depression in 2030, and is there any way to avoid it?
Yes, we are predicting a depression for 2030. The way to personally avoid it is what we are going to be talking about, my brother and I being the we. We have a new book coming out from Wiley Press. It will be published in July 2014. Takes a while to write them and then to get them through the publisher, but in July 2014, our book, which is at the moment, I believe it will continue to be called Prosperity in an Age of Decline, will be available. It will answer that question depending upon your age, and it'll point out the winners and the losers in terms of industries, investment techniques, as well as the causes for the Great Depression. So one of the answers to that question is, if we see that the causes that my brother and I have identified are effectively dealt with by our political leadership, then the threat of that Great Depression is at least reduced, or the magnitude of the depression is reduced to a recession. So we will go through all of that in the book, but the answer is yes. They can be simple things like we get hit by a comet. Now that really changes everything. We could find a flu that really, and this doesn't sound like happy news, but it really decimates the elderly population of the planet. That changes everything. A spirit of self-sacrifice, giving, comradeship, and compromise could break out in Washington. That would change everything. I personally put that last one under the heading of we could get hit by a comet. You know, it's not real probable.
All right, well, Alan, thank you. That's it for our questions. Again, I'd like everyone to thank everyone for participating, especially you, Alan, for helping to lead us and handling the forecasting program for ASA. Again, those of you that haven't registered for Network in DC, I'd like you to go ahead and do that now. As part of not only just listening to Alan, you'll have an opportunity to visit your members of Congress and talk about tax reform, which they're starting to gear up right now in Washington. So you'll have a chance to weigh in and help to protect your business. So again, thank you all. Give us a couple of days to post this on the website, so you'll have access to both the slides and the presentation. And again, thank you all. And Alan, we'll see you in Washington in about a month and a half.
I'm really looking forward to it, Ben. Thank you, Ben and Mike, for letting me be a part of this today. I'm really appreciative of my relationship with the ASA and with you too. Thank you.
Thank you all.